Hey there, stock market enthusiasts. Ever wonder why some stocks take off like a rocket while others crash and burn? Well, buckle up, because we're about to dive into the juicy world of earnings, the secret sauce that makes or breaks a stock's performance. You know, there was this one time that I bought shares in a coffee shop chain, just because I couldn't stop guzzling their delicious coffee. I figured if I was this hooked, others must be too. Turns out, I was onto something. That stock perked up faster than their espresso shots. But here's the kicker. It wasn't just about how good their coffee tasted. It was all about those sweet, sweet earnings. Now, let's break this down. Earnings are like the fuel in a stock's engine. The more fuel, the higher it can climb. When a company's profits keep growing year after year, it's like sending out a bat signal to investors. They come flocking, then boom. The stock price shoots up faster than you can say. Cha-ching. Take Apple, for example. Last quarter, they reported a 10% increase in earnings per share. What happened next? The stock price jumped like it was on a trampoline. When earnings go up, it's like the market's throwing a party for the stock, and everyone wants an invite. But hold your horses. It's not just about the numbers. It's also about beating expectations. Wall Street analysts are like those know-it-all weather forecasters. They set the bar for what a company should earn, and if a company leaps over that bar, it's champagne and confetti time. But if they stumble, well, let's just say it can get uglier than a bear in a tutu. I remember this one tech stock, won't name names, but let's call it Gadget Co. They beat earnings estimates by a measly penny. A penny. And what happened? The stock shot up 15% faster than you could blink. On the flip side, I've seen stocks nosedive 20% just because they missed expectations by a hair. Analysts are like weather forecasters when they're wrong. The market either throws a tantrum or a ticker tape parade. Now, let me paint you a picture of what good earnings look like. Imagine you're running a lemonade stand. In your first year, you make $100. Not bad, right? But in year 2, you make $150. Year 3, $225. See the pattern? That's consistent growth. My friends, it's like your lemonade stand is the talk of the town, and everyone's lining up for a sip. This kind of steady growth isn't just about luck. It shows that the folks running the show know what they're doing. They're making smart choices, expanding at the right pace, and probably have a few tricks up their sleeves for future growth. It's like they've got a crystal ball for business opportunities. Let's flip the script and look at weak earnings. Say your lemonade stand earnings go from $100 to $90, then to $80. Uh-oh, that's about as appetizing as warm lemonade on a hot day. Investors see this, and they start heading for the hills faster than you can say sour lemons. But here's where it gets interesting. Sometimes, a company can have killer earnings, but if Wall Street expected even more, the stock might still take a hit. It's like acing a test with a 95%, but your parents were expecting a perfect 100. You still did great, but somehow it feels like a letdown. Now, let me tell you about the time I got a hot tip on a can't-miss stock. This guy at my gym, built like a tank, brain like a peanut, swore this biotech company was going to cure baldness or something. It's gonna explode, he said. Well, the only thing that exploded was my wallet, and not in a good way. The company had no sales, no profits, and apparently, no clue. I learned my lesson. Stick to companies so boring they'd put your grandma to sleep. Those are the ones that make you money while you're napping. Here's a pro tip. When you're eyeing a stock, don't just look at one quarter's earnings. Zoom out and check the long-term trend. Is it steadily climbing like a determined hiker or bouncing around like a kangaroo on caffeine? I love to see consistent annual earnings growth year after year. I calculate the stock's compound annual earnings growth rate over 3, 5, and 10 years. This is great to seeing the earnings trend. Consistent growth is what you want to see. It's like dating. You're looking for stability, not drama. And speaking of drama, earnings season is like the Super Bowl for stock nerds. Every 3 months, companies spill the beans on how they've been doing. It's a roller coaster of emotions. Stocks soaring on good news, diving on bad news, and sometimes doing the exact opposite of what you'd expect. I've seen stocks drop on good earnings because they weren't good enough. The market can be pickier than a toddler at dinner time. But here's the real secret sauce: guidance. That's when companies give their best guess about future earnings. It's like they're looking into a crystal ball, and investors eat it up. Positive guidance can send a stock to the moon, even if current earnings are just so-so. It's all about the future, baby. I remember this one company. Let's call them Widget Wonders. Their earnings were flat as a pancake, but they announced they were expanding into a hot new market. The stock took off like a rocket. Why? Because investors were betting on future earnings. It's like buying a lottery ticket, except with slightly better odds. Now, don't get me wrong. Earnings aren't everything. You've got to look at the whole picture. Is the company drowning in debt? Are they one-hit wonders? Or do they have a whole catalog of greatest hits? I will take the catalog of hits over one-hit wonders every time. The amazing thing is, if you look at the annual earnings growth rate over multiple years, like I do, This will tell you if a stock has the catalog of hits, or just that one-hit wonder. So at the end of the day, earnings can tell you a lot about what you need to know, as it's the heartbeat of a stock. Strong, steady, and growing. That's what you want to see. Let me leave you with this. Investing in stocks is like picking a good melon. You thump it, you smell it, you check for bruises. But with stocks, you're thumping those earnings reports, smelling the guidance, and checking for any bruises in the financials. Do your homework, and you might just find yourself with a portfolio sweeter than a ripe melon. Remember folks, in the stock market, earnings are king. They're the fuel that sends stocks soaring, the lifeblood that keeps companies growing, and the yardstick that measures success. So next time you're thinking about buying a stock, take a good, hard look at those earnings. Are they growing steadily? Beating expectations? If so, you might just have found yourself a winner. And who knows, maybe one day you will be the one giving out hot stock tips at the gym. Hopefully with better results than my bald cure fiasco. Now go out there and make those earnings work for you. Happy investing, and may your stocks always be on the up and up.